Hello, everyone, and welcome to IndiNations, 7 Generations Investing. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to talk about the costs of cash. Really, the subtitle here is The Hidden Price of Playing It Safe. You know, I've had a lot of conversations with everyone in kind of Indian country, investing and just traditional finance and those kinds of things. And a lot of the commonalities I hear is we have a lot of cash on the sidelines. That there is both, the thought of having that cash is something that, again, playing it safe, doing that for something down the road and those kinds of things. And then externally, a lot of the people who facilitate work for Indian country have said, yeah, they're just, the people I talk to, there's just a lot of cash and there's a lot of holding things in checking accounts, and checking accounts can be very sizable. Totally get it. I totally understand the thought process behind it, but my job today is going to just talk about what those costs are. And sometimes the trade-offs are worth it. Don't get me wrong. And there's some elements of cash that are absolutely that it's going to be there, that it's that warm security blanket. Makes perfect sense to me. But I just want to talk about some of those risks and some of those trade-offs that people may not think about when they think about holding that cash. So let's get started. A couple of questions I want you to consider is, the first question is, what's the safest thing a tribal treasurer or CFO can do with community assets? And I think most of you that are watching this right now would say, I can put it in the bank. I know it's going to be there. I know I can take it out whenever I want. May not grow for me a whole heck of a lot, but hey, the assets are there and I know they're going to be there and I know I can use them when I need to. That's the safest thing I can do. It's FDIC insured. Absolutely. I think that is the safest thing. That is one of the safest things you can do, is put it in the bank and let it sit there. It certainly is an option and probably the safest option for you. My next question, though, is the safest thing the prudent thing to do? That's a little different question. And sometimes that answer is absolutely yes. But sometimes I think there are better opportunities to allow your assets to work for you, which, again, when you're talking about being a fiduciary for community assets, that's what you want those assets to be doing. So there are resources, there are resource availability and things you can do with your money that will create more money down the road to utilize to execute on whatever mission that may be. And I think that's often the most prudent use of your assets. So why do tribes often remain in cash? And I think there's some culturally specific issues in Indian country that create just a natural higher degree of risk aversion. Which, again, risk aversion is not necessarily a bad thing, but there are some opportunity costs that come as a result of it. But let's talk about what some of those issues are here first. And I think there's a historical mistrust of financial institutions. Oftentimes in Indian country, they have a long legacy of people coming and telling them what they should do with, whether it's their land, whether it's their resources, whether it's, now that there's gaming has become prevalent, what you should do with that. There's a long and extended history of people trying to use Indian country for their own missions, their own purposes, and sometimes not under the biggest component of trust. So historical mistrust has been bred over several generations, which is absolutely makes perfect sense. But that natural mistrust, or that historical mistrust, is probably going to lead to greater risk aversion rather than less, right? No established infrastructure or investment policy statement. So I see this one as, we are now getting pools of resources coming in, and those pools of resources can come from very different avenues. They can come from federal grants. They can come from land grants. They can come from gaming. They can come from economic development. They can come from resource development, infrastructure, that things are coming in that maybe weren't coming in before. But as a result of having this now, if you don't have a structure that's in place that allows you to say, okay, what do we want to do with this now? And how do we set up the proper structure so we invest it properly to execute on that mission? Without that in place, what you can see is a lot of, okay, we need to build that. We need to build the structure. We need to build an IPS. How do we do that? Okay, what's the process of that? Well, you know what? I've got other things that need to take precedent right now. I'll get to that down the road. But getting to that down the road, that can delay those types of to the activities that you want to use this money for. And so from that perspective, again, okay, for now, I'll just put it in the checking account and we'll develop the infrastructure, we'll develop the IPS, and then we'll get that going to work for us. Well, that process, again, through those delays can just get delayed and delayed and delayed. And the money has been sitting there the entire time. And not only sitting there, it may be growing over an entire period of time as you're putting more and more in there. Now, it's not working for you, but it is there. On the other side here, I think government transitions create change and uncertainty, right? Is again, I've talked about this before at IndiNations, is you are investing in a lot of instances for the next generation or 7 generations down the road, but you're doing that within the confines and with the uncertainty of election cycles. A lot of times it could be 2 years, could be 4 years, whatever that cycle may be. Whether you are an actual tribal council person that is elected, whether you're an elected official, or whether you're an administrator or a CFO that has to answer to those, though, the tribal council, that still is a method of change and uncertainty that can create some, those transitions can create that change and uncertainty that allows it and creates the ecosystem for some level of risk aversion. If you don't know what's going to happen in the next couple of years, or you're seeing somebody that has a very different agenda, well, you're maybe not going to do the same things you would do for a 25 or 30-year investment process. The last one I think is more mental in nature, but it absolutely makes perfect sense. And this one tends to be a little bit more universal, is paper losses are visible. If you invest in something that has risk, and that risk goes against you where you experience some losses, those things are visible, right? Is that most tribal treasurers, most CFOs are answering to whether it's an investment committee or the council in and of itself. And then at the end of the day, because you're a fiduciary, because you're acting in the best interest of the community, you are also relaying this information to the community. So those paper losses are visible and you have to explain what you did and why you did it and all that stuff. Whereas opportunity cost, of, hey, I could have invested in this, but I didn't. I kept it in cash. Well, that cash is still, if you had $100,000 in there and 6 months down the road, that $100,000 is still showing in that account. The opportunity cost is invisible to most people. It's like, oh, we could have done this and then we would have had that, but I don't have to explain that. We were just in cash. We still have the same amount of money there. So there is that component of having, the visibility of this. About risk aversion comes from the fact that you see losses, as opposed to opportunity costs where the gain is kind of invisible or abstract compared to the realness of a statement that says your money is lower. So all of these together combine for, whether it's culturally specific, whether it's universal, I think, again, mesh, especially in Indian country, to having just a higher degree of risk aversion overall, and why there's probably higher degrees of cash overall in banking accounts that maybe could be utilized for a better purpose. So cash feels safe, but is it? That's the question here. Again, on the left-hand side is a nice warm blanket. That's what cash can feel like. It feels like security. It's there. And I know it's going to be there. And I know it's going to be there down the road. And it's FDIC insured. I got that part down. It feels like a warm blanket. It's a level of security for that. But what I want to ask is, who and what is this money for really? Because again, on the bottom part is community assets. You have a fiduciary responsibility as a tribal treasurer, a tribal CFO, anybody who's executing on behalf of the community and has assets that are investable as part of the community should act in the best interest of that community. That's what fiduciary responsibility means. And so delineating who and what this money is for will allow you to better delineate how it can work for you in the future. Is that cash can feel like a warm blanket, but it's really not going to work for you over an extended period of time. And I'll show that in a second. But the component of understanding what this is for and the time horizon you have to get it done really should be the primary factors in delineating how you invest this money going forward. So with cash, again, I said it feels like the warm blanket, but the warm blanket is impacted and influenced very negatively by inflation. And this chart is, I tried to keep it as simple as possible. I don't want to get into the weeds about all this stuff, but really since 1987, so a very long period of time, the US dollar has lost over 60% of its value. So a dollar does not buy what dollar's worth of goods in the future. It buys less. So the dollar you have now will buy less in the future. Inflation is consistent, even under quote unquote normal circumstances. The US Federal Reserve targets 2 to 2.5% inflation as normal, healthy economic inflation. So that means under normal circumstances, you're losing purchasing power over an extended period of time. That the bank, and if you're not getting any interest off of that, and frankly, from a bank account, you're probably not, and if you are, it's minuscule. But from that perspective, you're not generating enough to keep your purchasing power the same. You're going to be losing purchasing power over an extended period of time. That's what inflation does. It erodes your purchasing power, And in instances that we've seen in 21 and 22, and now a little bit here now, not to the degree we saw in 2021 and 2022, where inflation was rising rapidly. What that really means is the faster that's rising, the more purchasing power you're losing. You're losing it quicker. And so we haven't really had controlled inflation. We got pretty close last year, and in 2024, it was starting to get more normalized. We've started to reaccelerate here a little bit. We've had higher gas prices, higher food prices have been a problem for a while, to where those kinds of things are eroding purchasing power a little faster. We're not in normalized range at this point right now. We aren't as bad as we were a few years ago, but we're certainly not. We're still having relatively high inflation, which means if the money is in the checking account not earning anything, you're losing purchasing power faster. And you can see that over an extended period of time, again, going back to 1987, it can have a real dramatic impact on your purchasing power going forward. So what do we do to combat that? I think you invest. I think that's really what you have to do. And you have to understand your purpose. And again, you have to understand your time horizon to tell you how to invest. But I think putting that to work for you is a good beginning process. And so what I wanted to do here, and I know it's a lot of numbers, and I try not to put a lot of numbers and data into things. I want to make it more explainable without having to do that. But I really wanted to show what the purchasing power and the offset of investing can do to your purchasing power and to make your money work for you over a long period of time, while also addressing what can be really negative times for some of these asset classes. So again, these on the left-hand side, we have the asset classes going probably in order of risk, not completely, but pretty close. Short-term US Treasuries considered one of the safest investments. US bond market, a little bit riskier, but still in bonds. So you still have a maturity date, and they tend to be relatively lower volatility than what the other asset classes here are, which is the US stock market, ex-US stocks, which just means everything else outside of the US in stocks, and then gold, just as kind of an alternative asset class. You can build a pretty good portfolio just out of those 5 asset classes. And really, your determination of what to invest in and how much to invest in will, again, based upon what are you trying to do and how much time do you have to do it. Because if you have 6 months, you should be nowhere near the stock market. If you have 50 years, you shouldn't probably be a whole heck of a lot in treasuries if this is perpetual money, because you want that to grow over an extended period. And so this is where that kind of proves that out. And so this goes back to January 1987. So this is a very long period of time. And why I chose annualized return first is a lot of times people look at annualized return and they'll say, well, I don't know what that means. 4%, that sounds great. It's pretty low. I don't know. What does that even mean? Well, 4% annualized return since 1987. If you had $10,000 in January of 1987 and you received a 4% annualized return, what would you have? You'd have $47,000, a little over $47,000. So again, by investing in one of the safer instruments, U.S. Treasuries, you've gone from 10,000 to 47,000. And that 4% has been higher than the rate of inflation during that same period of time. So you've actually increased your purchasing power by investing in one of the safer asset classes. And I look at this and I say the worst performance. In the investing world, we call that drawdown. So there's a maximum drawdown. So what is the worst from the highest level to the lowest level? What is the worst it ever experienced during this period of time? Well, U.S. Treasuries, the worst it ever experienced was minus 6%, which, it's not great. It's not fun to see money down 6%. But in terms of overall loss, that's not aggressive. But you did experience a little bit of loss during, the worst period of time in treasuries. But again, to take that slight level of risk of that worst performance, you did increase your purchasing power by now generating $47,000 from your initial $10,000. Now let's go down the risk curve a little bit. Let's take a little bit more risk and talk about bonds. Annualized return. You can see it's higher than treasuries. You're getting paid to take that risk over an extended period of time. 5%. 5% equates to $68,000, a little over $68,000 from your original 10. Again, over a very long period of time, you generated $21,000 more than if you invested just in treasuries. But what's the trade-off to that? The trade-off to that is you had to experience a little bit worse decline during the worst time from 1987 to 2026. Remember, there were a lot of bad times during that. You had Black Monday in October of 1987. You had the dot-com crash. You had the great economic downturn of 2008 and 2009, and you had COVID in 2020. So you've had a lot of things happen during this period of time that were very, very negative. And so what's the worst we did during that period was minus 18%. And that is actually relatively recently. That was in 2022 when interest rates skyrocketed from basically zero to a higher degree of level. Well, when interest rates go up, bond prices go down, and you had an 18% decline during that period of time. But again, even including that 18% worst performance during that period, you still enhanced your purchasing power over that period of time. Now we talk about the more riskier assets here in this US, let's go US and international stocks. So the US market has been phenomenal for an extended period of time. So the annualized return is 11%, more than twice that of bonds. So what that means, when you say twice, it's like, well, okay, so bonds returned 68,000, that did twice as good on an annualized return. Should I have 120,000? It's not how money works. Compounding interest is one of the, what did they call it? Einstein called it one of the best, one of the best things in the world. But just look at the difference. An 11% annualized return turns that $10,000 in 1987 to over $600,000 during that period of time. Again, this is a very long period of time. It's almost 40 years, right? But look at that level of growth, is that you have used that money to now just massively exceed that level of purchasing power. You have much more than done that. And now you've created opportunity sets for you to utilize more resources to do the things you want to do. That's what investing should allow you to do. What's the trade-off of that? Again, I told you the worst performance recently happened in 2022 for the bond market at 18%. Well, it was 3 times worse in the stock market, minus 51%. So that was the period of 2008. So in 2008, remember when we thought we weren't going to have an economy the next day? By March of 2009, we were down over 51% during that period. But even incorporating that, again, these numbers incorporate that, and it still came out to over $600,000 from your original $10,000 in 1987. Ex-US stocks, again, haven't been as good as the US market, but still, $10,000 turns into $110,000 over that time frame. But you had to live through an even worse performance of minus 59%. It was at that same period of that 2008 and 2009. So really substantial. That's going to feel. Nobody gets away with that one scot-free. That is painful. There's no question about it. But again, over a longer period of time, you are rewarded for taking that risk. Now, if you wanted to do it, and again, if you needed this money in 6 months, you should be nowhere near those types of investments that could lose 59%, because you need that money very soon. But for over longer periods of time, you accept that level of volatility. You understand it's going to be painful when it happens, but it happens relatively rarely. And the compounding that you get over an extended period of time is what allows you to have your money work for you. And then gold quickly, basically the return is the same, about $110,000. You had to take a 48% decline during that period of time too. You have to remember is that gold acts as kind of a diversifying asset. So that 48% didn't happen at the same time you were losing 50 and 59 from the stock market. It happened at a different time. So gold can sometimes be a diversifier and have different return streams. So when the stock market's not working, gold might be working. And then when the stock market's not working, and then the stock market's working, gold might not be doing so hot. So those are the kinds of things. Sometimes they work together, sometimes they don't. But overall, diversification is an element to reduce your risk over an extended period of time. And again, understanding your time horizon allows you to know where to invest within these buckets. So all of this kind of goes back to what we call our tribal treasury model, is understanding what your purpose is for the money and the time horizon needed to get it done. And so if you look at the left-hand side, again, operating cash to, the rainy day holdings, that's your safety bucket. That's capital preservation. You don't want to mess with that stuff. You don't want to take a 40, 50% decline in there. So you're going to invest in things. And this includes cash. This includes the component that you're going to have in the checking account. That's absolutely fine. And then we're also going to have some investments that generate a little bit better return than certainly the checking account, to hopefully offset the effects of inflation within there, so that your purchasing power stays the same or grows, but your risk is still relatively low. Your reserve funds, your capital projects, the stuff from 1 to 7 years, that can be a little bit more balanced approach. Take some growth, but also protect from that downside risk, because you do have a thing that's coming up, whether you're replenishing your operating funds, whether you have a capital project like a health facility or something like that that you're investing for. You don't want to take the full brunt of that 50% decline in the markets. You want to allow yourself some balanced risk within there, but you can grow these a little bit faster than you can on your capital preservation side. And lastly, on your long-term assets, that's your higher volatility. You have to accept that you're going to take some risk. You're going to ebb and flow here. This is where you want to delineate for higher potential returns. The stuff we're not going to need for a while, whether that's perpetual, and hey, we're going to have these funds and we want these funds to grow so that we could use them for a bereavement fund or a minor's trust or whatever that may be. You want to accept that higher volatility here for that potential of higher returns going forward, to allow that compounding that I showed before with the stock markets, where you're getting significantly greater assets over an extended period of time by allowing compounding interest to work for you. So if this was helpful, this is part of our Treasury Playbook for Tribal Nations. I will leave a download in the link below, to feel free to take a copy and take a look. And also, if you have any information or any questions that come as a result of this, or you're working on anything within this camp, please just give us a call, hit the comments here, and I will reply to you. That's all we have for this week. Tune in next week, where we'll have our next hot button market topic or investing topic for IndiNations. But until then, thank you very much and take care of yourselves.